Joining me now is Jill Carey Hall of BofA Securities. It's good to have you back. You know, I don't need to tell you that this has been a dreadful place to be this year. Do you feel like you have any visibility into when you think it might turn?
Well, I think the earnings backdrop is important because if you think about, a year ago at the start of 2024, that's what got investors excited in small caps was the earnings recovery. We were coming out of the 2023 earnings recession. Everyone was expecting that by mid last year, these stocks were going to be seeing, double-digit earnings growth that would be outpacing large caps. That got pushed out more than a year. And so now, we've obviously sold off a lot, and we've obviously gotten some potential good news on tariffs, but there's still a lot of uncertainty, and we're in a backdrop where earnings revisions have still been negative. So I would feel more comfortable if we're in a backdrop where there's more confidence in that earnings recovery, because last earnings season the commentary was a lot more negative from small cap companies than large cap companies, and so far this earnings season it's still early for small caps, but guidance in both large and small has been weak. So I think if we can see earnings revision ratios start to turn around, if there's a lot more confidence, if not only the tariffs are better than expected, but the economic backdrop is better, that would be a better picture. But we're also in a place where our economists think the Fed stays on hold this year, and the Russell's been very sensitive to Fed expectations.
Yeah, no doubt about that. We talk as though, all small caps are created equal. Of course, they're not. Is there a portion of the small cap area that comes out of the malaise first?
Yeah, look, I think this is definitely a year where you want to be selective because, as everyone's seen, there are groups of stocks that are more sensitive to tariffs. There are groups of stocks that are more global versus more domestic. There are groups of stocks that are more levered and have higher refinancing risk within small caps if rates stay high or if credit spreads stay elevated. So, I would stick with higher quality small caps. Profitable stocks, anything that has strong operating margins. Those have been some of the best performers within the size segment recently, given all of the tariff risks. So more higher quality domestic small caps, stocks with strong margins, stocks that are seeing positive revisions in this broad backdrop of negative revisions. I think from a sector perspective, if you're still looking to be a bit defensive, utilities screens well across our work, both within small caps and large caps. So I think there, will be opportunities within this size segment if one can be selective. I also think mid caps, within this mid space, mid caps, which have been the best performing size segment this year, we've liked mid caps for this year. We think they've seen much better revision trends. They have cleaner balance sheets. They're, less at risk from potential earnings hits from tariffs than small caps because small caps have thinner margins and could see a greater hit. So we do like the mid cap segment.